Talks. Actually, I'm Gene Trowbridge, and this is TLG Talks and Trowbridge Law Group. We're securities lawyers. You all know that. Today, I want to talk to you about understanding the passive loss rule. This is an important rule, and it comes into play at this time of the year, which is tax season. And if you watch my presentation on depreciation, you kind of heard the words of passive losses, generally because just because the property produces a loss, which may very well and hopefully be determined by cost recovery, cost recovery and interest write-offs being greater than the income to the property, that doesn't necessarily mean you can use those losses to shelter other income. We have people calling us right now, sponsors and clients calling us and saying, hey, I thought I had a lot of depreciation. I thought I had a lot of losses, and I expected those losses to shelter my W-2, my 1099, or my K-1 income. Not so fast. You need to understand the passive loss rule. And we write a little bit about the passive loss rule in our operating agreement and our PPMs so people understand. But we really need to have the sponsors go to the CPA and talk about how would the passive loss rules apply to most investors in this case. Generally, we don't do presentations to investors on an after-tax basis because everyone's different. But the general feeling from investors is if the property produces losses, they're going to be able to take it to shelter other income. Well, let's dive into that a little bit right now, shall we? Okay. Understanding the passive loss rule. This all came in 1986. The Tax Reform Act of 86 changed everything we do. And one of the things it did is it defined two types of income: passive income and active income. Passive income generally is defined as income that's produced when the investor doesn't have a material role in producing the income. So certainly investment in an LLC by an LLC member would meet the definition there. But also, the Tax Reform Act defined rental real estate as a passive activity, which is kind of humorous. If you've ever tried to run an apartment building by yourself, you don't think that that's passive, but that's what the law says. So it's a passive activity. So, and it also defined investing in as a member in an LLC as a passive activity, not necessarily the manager of the LLC, but the investor as a member in the LLC, which most of you are. And then the passive loss rule goes on to state that losses from passive activities may not offset active income. Oh, so if I have a loss from a passive activity and I have income from a passive activity, there's kind of a line. The losses from the passive activity can't cross over the line to shelter my active income. That's what surprises investors this time of the year. The property produces taxable losses through cost recovery and interest write-off, but the losses don't move up to shelter the income from other sources from the investor, and they question that. So losses from passive activities that are not used currently are called suspended losses. So if you can't use them today to shelter your other income, then they're suspended and they can be used in the future. And then the last point is suspended losses from passive activities can be used in the future to offset income from passive activities. No doubt about that. So it's a year by year look. If you look at how did the property do this year, if it has a passive loss, the question is, can you use it or not? If it's your only passive activity, chances are you're not going to be able to use it against active income from some other source. If you have multiple passive activities, maybe that passive loss can be used against other passive activities. There's this line, and the passive baskets, if you would, the passive activities are all below the line. You can mix and match losses and income below the line, but to get a passive loss above the line is probably only going to happen at the disposition of the property. So let's look at that. Okay, here is an example. We have a property with $1 million of NOI. The interest payments are $600,000, and the depreciation that was taken this year is $600,000. So what do we have? We have a taxable loss from the operation of this property. Now the question is, can you use that loss? Well, what determines that? The passive loss rule. And what does the passive loss rule say? It says passive losses cannot offset active income. So we don't know right now if we can use that loss or not, but we do have it, and we're happy that we have it because the interest and the depreciation sheltered all the income that we made from this property. Net operating income on its own is taxable. Luckily, we have the write-off of interest and the write-off of depreciation to shelter that. So we already have $1 million worth of shelter, but people don't always grasp that. They always think, well, why isn't this 200,000 sheltering? You know, my 1099 last year was 200,000. Why do I have to pay any taxes at all? Well, because of the passive loss rule. And let's see how we can apply that. So here I'm going to look at this as an individual owner. Let's look at how this might work. Same property, $200,000 passive loss. Let's go over to see what the characteristics of the owner are as they get ready to report their taxes. The owner had $300,000 from active income. That's taxable. Passive income was $200,000. Passive losses, $200,000. So here we have this line separating active from passive. And in the passive baskets, we have income and losses. They offset each other dollar for dollar. So this passive income is offset by these passive losses. So the taxable income the taxpayer has to report is the $300,000 from their active activities. And because we used all of our passive income this year, there's nothing suspended. So this would be an example of someone who owns 2 pieces of rental property, let's say, individually, and they work on a job. They make $300,000 on their job. They have one rental property that produces $200,000 in loss, and they have other rental properties, one or more, that produce $200,000 of income. So the losses and the income in the passive baskets offset each other. Nothing to report there. So all we have is the $300,000 of taxable income coming from their active. And we use all of our suspended losses. Pretty simple. Now here's another example of an individual owner. This individual owner only owns one property, owns this property. Same property, $200,000 worth of passive loss from operating the property this year. The property made money, but between interest and depreciation, tax-wise, we have a $200,000 loss. Great, that's great. I can use that. Well, not so fast. This taxpayer has active income of $300,000 above the line. And below the line, it's $200,000 of passive loss with nothing available to offset. The passive losses can't shelter active income. So what happens? The taxpayer is going to pay income tax on $300,000. And the taxpayer is going to have $200,000 of suspended losses to carry forward. So next year when we start the analysis, we've got this line, Below the line is a $200,000 suspended loss, and it's treated as if it happens in the second year. So we start with some losses. Now we have to look to see, is there any income that we can use that can be sheltered by those losses? And we have to stay down here because we can't get them out of the passive baskets up until the active basket. I'm going to kind of give you the bottom line. You never actually lose the ability to take these losses. It's just the passive loss rules are just a timing mechanism that the government put into place to stop people from making investments just because the first 4 or 5 years tax losses were so great that they could shelter so much other income that was driving bad investments. See, in 1986, we're coming into a terrible time in the real estate market. People were investing in really empty buildings to get all the no income, a lot of interest, a lot of depreciation, a huge loss, which they could go over and just shelter all their income. You might have heard of people saying, well, I bought into something that had a 5-to-1 loss. I put $100,000 in. Well, this would be an example, a 2-to-1 loss. I put $100,000 in this property and I got $200,000 of write-off. My $100,000 was helped me with a 2-to-1 write-off. That's the passive loss rule stopped all that by making you suspend the losses that can't be used in the property that you bought until sometime in the future. Now let's see what happens here. Here is an LLC. We have an investor who owns 25% of the LLC. They're a member and they own 25%. Same property, loses $200,000 tax-wise. All of the income from the property is sheltered, so there's going to be good cash distribution. But because of the interest and the depreciation, it shows a $200,000 tax loss. Well, this investor makes $300,000 and has a passive loss coming from this property. His 25% allocation is $50,000. Well, his taxable income is $300,000. That $50,000 passive loss cannot come above the line to shelter the active income. The $50,000 loss is suspended. Here comes January 1st the next year. What does our picture look like? If we're talking pictures, our picture looks like I've got a $50,000 suspended loss waiting for what happens this year. Will I have some passive income that I could use that suspended loss to shelter? Maybe, maybe not. Maybe the property is going to act like this every single year. And all you're going to do is build up accumulated suspended losses. And that's generally what happens. Let's see, here we go. Okay, so what are the rules? In operations, suspended losses can be used against future passive income. Great. So in year 2, if we had suspended losses of $200,000 and we had current passive income of $50,000, so we started the year with $200,000 suspended. We had $50,000 passive this year. They mix together. Part of the 200 suspended shelters the 50. There's no income to report because it's totally sheltered. And now we go into next year with the $150,000 of passive losses, waiting for some more passive income that we can shelter. So now let's say we're ready to sell. And we are at $150,000 of suspended passive losses through the whole holding period. Suspended losses can be used against passive income. We already said that. So the first thing we have to look at on a sale is what happens to the property. In our analysis on the sale, the property sold for more than its basis, and we have a $500,000 income. It's a passive income because it's from a passive activity. So the first thing we look at is what's the passive income this year from the property? $500,000 of passive income. Well, do I have any suspended losses? Yes, I have $150,000 in losses I haven't been able to take yet. So now the suspended losses offset the passive income. And what do we have to report on the sale? $350,000. Now that may be reported as capital gain, okay? And that's a story for another presentation. But during the years, just remember this picture below the line, all this passive stuff happens, and passive losses and passive income can offset each other. The only way we get it above the line is on the disposition of all of our passive activities. And in this case, we had one, the property sold, there was a gain. And remember, the rule is passive income is always reported. So we have $500,000 of passive income, $150,000 of suspended losses, leaving us with $350,000 of passive income. The line goes away. You report your active income, you report your passive income, and treat it as what it is, hopefully capital gains, and pay the taxes on it. So suspended losses generally are not going to be able to be used currently. We're going to shelter the income from the property, but not your other income. Losses that are suspended can be used in future years against other passive income. And on the sale of the property, suspended losses are used to offset the gain. So you can always use the suspended losses. It's just a matter of timing. So does this look like something you should look at when you're going in to buy an investment in an LLC? Sure. You look at the P&L statement. You look at see what's going to happen. Are there going to be losses? And if there are going to be losses, what is your situation? I know people who have 25 or 30 passive investments in LLCs. Now that's a quagmire. They have all this stuff going on below the line, and a passive loss comes in, and it can be offset by any of the passive incomes. But if you just have one, the thing I'm worried about is you thinking, well, gee, there's this $200,000 loss. I'm going to be able to take it and offset my K1 or my W2 income. Not going to happen this year. Don't be surprised. Don't call the sponsor. Call your CPA. Should have thought about that ahead of time. So that's our message to you. Bottom line, passive losses cannot be used currently, but eventually they will all be used. It's really a timing issue. So that's the end of this presentation on our YouTube channel. I hope you subscribe to the YouTube channel. That would be great. We do a lot of things here, a lot of interviews, a lot of good information. If you want to contact us, our website is very active. You can call me directly. You can email me directly, or if you go to the website, you can just set up a half an hour free consultation call with me. And so this is Gene Trowbridge saying thanks for watching this episode.